Welcome to PrimeAlpha's interview series, insights from industry practitioners discussing their journey and their discoveries. Hello, my name is Amanda Jogia, the CEO of PrimeAlpha, an ecosystem bringing together alternative investment opportunities and their investors. I would like to introduce Spring Hollis, founder of Strong Capital, a private debt investment firm focused on lending to lower middle market companies, where she has invested approximately $145 million in private debt transactions since the inception of the firm in 2019. She is extremely accomplished with over 25 years of experience, and we will hear about her background, and she's a personal friend and someone I admire. Spring, thanks for joining us today.
Thanks for having me here, Amanda.
So let's just jump in. Spring, walk us through your career journey.
My career journey started as a lawyer. I've practiced law for what I think of as a heartbeat because I did it for a year, maybe 2 years, and then realized that it was really not my cup of tea. I value legal profession largely because I know that I can't do it. It's a really hard business. I left and joined a client. That client was Deutsche Bank. They came at the time after a deal that we did together and asked if I was interested in joining. I said yes. They asked if I wanted to know what the job was, and I said no. I was 100% ready to leave the law. So I joined the structured transactions group at Deutsche back in, I think it's 2000 now. At the time, the focus was on structured principal deals for the bank, and spent about 10 years at Deutsche doing that type of work on the sales and trading desk. From there, I took a break after the financial crisis when my kids were born, and then quickly realized that I wanted to be back in the financial industry. Went back as a portfolio manager at Park Cities Asset Management, focusing on specialty finance transactions, which I think is another way of saying lender finance. In that instance, it was really focused on small business funding and consumer-related credit products. From there, I left in 2019 to start this firm.
Describe that pivotal point in time where you decided to go off on your own and start Strong Capital.
There were a number of factors, both kind of personal and professional. The easy one on the personal side was that Park Cities was based in Dallas, Texas, and I live in Connecticut. I was commuting back and forth to Dallas, and that was a real tough time for me and my family. It was worth it until it wasn't worth it. Then I decided that that was a little bit too much of a stress on my family. But at the same time, I had been working on a lot of really large deals that Park Cities was funding, and I realized that I personally got more energy and intellectual feedback from working on small deals. And we looked at a bunch of small deals. The team at Park Cities was comfortable with me working on the smaller deals, provided I also did the bigger deals. But I found that for me personally, it was more rewarding to work on deals where I was interfacing directly with the CEOs and the management teams, as opposed to working with the CFO or the financial controller and not really having as much direct insight into the management of the business. I found that through working on the smaller deals, and by smaller in that context, it was 5 million or below, I had a better sense of the risk of each deal because I was really talking to the decision makers as opposed to several steps away on a finance team.
As you think about the private debt market evolution, what opportunity are you serving within that market?
We focus on, again, the smaller size deals. So most of the private credit industry now is really looks at much larger investment sizes. So I'd say 25 million to 50 million and up, depending on the platform. We still really focus on the smaller check sizes, which implicitly means the companies have a lower revenue line, a lower EBITDA line. It's all still proportional to the amount of debt that we're providing. But to our mind, we get a better sense of a business if we can directly interact with the management team. And that tends to happen more so with deals where our ticket size tends to be 5 million or below. That said, it's a moving target. And as private debt has gotten more prevalent in the market over the last, let's say, 5 years or so, there are definitely players in the smaller size, but the way that we approach things is much more with alignment and focus. Like, we really want to know and interact with the businesses that we work with because we're putting ourselves on the line every time we fund somebody. And that doesn't appeal to everybody.
If you think about private debt, how should investors think about private debt? And I know they think about it in different ways, whether it's fixed income bucket or an alts bucket. We've had multiple discussions about this. And also thinking about it's alts. You're kind of also in the bucket of how do you look at this versus a hedge fund or a venture? How would you think about that? Or if you could put some framework around that, that would be really helpful.
Depending on the investor, a lot of folks have put private credit either in their fixed income bucket or in their alts bucket. In the first instance, for fixed income allocations, I don't think it really makes as much sense as traditional fixed income, which is really more focused on liquid parts of the market and public bonds. The characteristics of private debt itself are such that they're not liquid. You're not necessarily going to be getting liquidity at a moment's notice in the event that you needed it, like you can in the public market. So it's a fundamentally more restricted position. That said, it generates cash flows. And that is also something that's been really interesting to the investor community, especially in the last couple of years when there's been less liquidity in the market. That while you're not trading on a principal position necessarily, you are getting cash flows on a current basis, which we look at and our clients look at as defeasing the risk, because whether it's every month or every quarter, the assets are paying, which is reducing the exposure to the individual names within that portfolio. As it relates to a private's characterization or an alt's characterization, I think it does have a universe or have a life within the alts bucket. Again, largely because of the illiquidity associated with it. Now, that said, it's not an alt like a hedge fund would be, where there is, again, implicitly more liquidity. But there are structures that are available that allow an investor to continue to defease and offset their principal risk. And that's whether it's through the current cash distributions or the nature of the underlying asset, which itself may be amortizing. And those amortization payments can be used to offset an investor's risk position or increase the return on their risk position.
How do you see the evolution of the private debt space?
The private debt space has always existed, and it's existed perhaps different definitionally based off of who the funder is, whether it's a bank or a non-bank lender. But it's existed largely because the banks have not been, whether it's a large commercial bank or investment bank, the banks themselves have always been a part of this market. Over the last, I'd say since the financial crisis in particular, banks have largely pulled out based off of the risk capital implications of them being involved in this market. And that's true whether it's, again, on the investment bank side or the commercial bank side, which has really opened up the universe and the opportunity set for non-bank lenders to come in. That said, non-bank lenders have to be funded by somewhere, and that comes from typically private capital, but also banking capital that goes into it. And it's evolved since then. It is a significantly balance sheet intensive business because definitionally you're taking on a significant principal position, which is not efficient for banks to get engaged in because banks have to hold capital against all of those positions. So it's just not the best use of bank capital to continue to be in the private credit world. From there, we had an explosion really of on-bank capital provider or online capital providers, whether it is the Cabbage, on Decks of the world, that really kind of Lending Club, Lending Tree, I don't remember all of them, that really became really prevalent in the mid-teens-ish. And they really grew very substantially, probably until 2019, 2020, when there was a lot more consolidation in that space. And some of those, Cabbage, I think, was bought by Amex, and you can go down the list. Those tend to be providing, those historically had provided much smaller check sizes to commercial borrowers and individual borrowers. So those were, let's say, could be anywhere from $50,000 to $250,000 loans that were being made both on a one-to-one direct basis, but also through online automated underwriting, which had its own flavor at the time. But since then, it's really evolved into a much deeper space where middle market companies are securing access to capital that would otherwise traditionally, historically, been provided by banks, but banks just really aren't in that part of the market anymore.
People always ask, what did you do wrong and what did you learn? But I tend to go on the other side and say, what do you feel like you did right starting your fund or your firm?
I started it with my own money, and I really felt like if I didn't believe in me, why would anybody else believe in me? So I put my money where my mouth is, quite literally, and really started with my own balance sheet. And that, I think, beyond creating alignment, it was my business to make or break. And I think that's really important in terms of, at least for me, because it created a lot of financial accountability. Family eats off of it. So the nature of the business itself is something that it's a business. It's not necessarily just reliant on the performance of one asset or another asset. It's not a hobby. It's something that we take very seriously and have fully backed ourselves. In particular, I started it and realized that I was going all in because this is what we do.
How has the private credit market evolved over the last 18 months? And what is the current landscape looking like today?
The last 18 months has been bananas in private credit. The impact of the rate increases cannot be overstated. And having the base rates increase by 5 percentage points in 12, 18-month period has really changed credit in a pretty significant way. I'd say for the industry itself, it brought a lot more attention. And there are definitely fund managers out there that are raising a ton of cash based off of the promise of a much higher return environment. Although I would caution on that because the increase in the rate environment has also created a lot of stress with respect to the underlying companies who are the borrowers. The bulk of the middle market and higher type borrowers may not be experiencing that stress in the same way as those on the lower end of the credit spectrum. But the consequences of those rate increases has been very real to the smaller and emerging businesses environment. If anything, the ripple effect as it goes all the way down to consumers has been material. Inflation has not gone away. And not to place any judgment on whether or not it should, the characteristics of underlying decision making have been very stressed, and that creates a stressed environment for those smaller businesses. While there's been a big narrative, I think that in the professional investor community that it's the golden age of private credit, I'm not sure that I would second that. It may be the case for the bulger brackets, but especially in the lower middle market or the lower middle market aspirational, as we like to call them, they're experiencing a lot of stress. And that means that underwriting has got to be really tight, and there's a lot less wiggle room for those companies to be successful.
What are the ongoing macroeconomic concerns that should be concerning to private credit investors today?
I think that speaks to the same thing. Certainly, the interest rate environment and inflation and consumer discretionary decision making, I think, have a really material impact on private credit performance, which is what really should be the focus of private credit investors. A lot of folks are on hold right now, given the pending election in the US and the perception of a change in the economic environment that may result from that. I don't necessarily see that quite as much, but private credit itself as an asset class it's not a liquidity source. And this is something that if you're taking a private credit position, on average, the underlying positions are going to be anywhere from 3 to 7 year hold periods. Our portfolio tends to be on the shorter end, so we can be 12 months to 36 months. So we can be a little bit more responsive. But once you're in, there isn't a lot of liquidity in the asset. So you have to be very comfortable that the underlying asset performance is stable enough to generate the returns that you're looking for in a variety of different economic contexts. The variability right now, I'd say, is at least kind of my part of the market is much more stressed than, I wouldn't say distress, but more stress for those underlying companies. And you have to be very confident that those companies are going to continue to exist, if not thrive, over the next 3 to 5 years.
Thanks for taking the time to talk with us today. We really appreciate you taking the time to walk us through your journey and give us a little bit more insights into the world of private credit. Thanks, Spring.
Thanks, Amanda.
Thank you for listening to PrimeAlpha's Visionaries and Innovators podcast. As always, you can head over to primealpha.com to sign up to our email list, as well as check out our other podcasts. See you next time. This podcast is for informational purposes only and does not constitute an offer to sell or a solicitation of an offer to purchase any investment or any securities. Listeners should make their own investigations and evaluations of the information contained herein. Certain information contained in this podcast constitutes forward-looking statements. Listeners should not rely on these forward-looking statements. Listeners should bear in mind past performance is not necessarily indicative of future results.